sometime in the next 2 weeks, the U.S. federal government is going to run out of money. Now, it's a little concerning that we don't know when that day is. Some people have floated 2 days from now. Others are floating as long as June 5th, at which point the federal government's credit cards have been cut up and they're not allowed to borrow any more money, and they won't be able to pay out to those who have loaned the federal government a whole bunch of money through treasury bonds and savings bonds. They will have to say, well, we'll get back with you later. I promise I'll pay you next week. Sort of like a loan shark kind of thing. But when that happens, what will that really mean, and how bad of a situation is the U.S. federal government in? Let's walk through that. I'm Steve Poplar, and welcome to the Poplar Report. I'm an accountant by trade, and we look at the numbers of things, and we're going to be going through some numbers here. And as you hear the numbers, you're going to hear how bad things are. We're going to try to put this cookies on the bottom shelf, so to speak, to make this easy to understand, but it should get you to the point of realizing how up the creek without a paddle we really are. Okay, so in 2022, of all the wealth that the United States produced, 20% of it went to the federal government. So they skimmed 20% off the top. Now, that's just the federal government. We're not talking about state or local governments. We're not talking about anything else. Just the federal government. 20% of it went to the federal government. They decided to spend $6.27 trillion in 2022. They took in revenues of approximately $4.9 trillion. So those of you running the numbers right there, you'll see that we spent 28% more than what we took in. Imagine if you have a salary of $50,000 and yet you decided to spend $65,000. That's approximately about where we're at. Now, using that same idea there, imagine that you make that $50,000, but instead of just being flat, you owe $300,000 out with no assets backing it up. You have $300,000 on credit card debt, and yet you're still spending $65,000 a year. If we were to cut the federal government, all expenditures across the board by 50%, I'm talking defense, I mean Social Security checks, I'm talking everything, even congressional pay and funding and pension. Did you know that there are actually 20,000 employees that worked for Congress? In order to have Congress, we have to have 20,000 employees. That's staffers, that's representatives, that's all, the people that run the committees and all that kind of stuff like that. Average wage, $200,000. You say, we have 20,000, $200,000 employees just so we can have Congress. Yes. $4 billion worth of salaries in order to have Congress a year. And if you take in like health care and like pensions and all the fringe benefits, that's like another $4 billion approximately. So yeah, we could have a brand new aircraft carrier every year, or we could have Congress. A lot of us kind of see that as a pretty cut and dry decision there, but we're not in Congress, so that is what it is. But imagine we cut across the board 50%, which obviously could never happen. Cut 50% of the jobs in the federal government and cut Social Security by 50% and cut our military by 50%. That could not happen. But if we did that, it would only take 19 years of no recession for us to pay back our loans, all that the federal government owes. Yeah. Seems kind of funny. Now, just go back to 2008 when we actually had a recession. We lost about 20% of government revenues for 2 years. It took 5 years for the tax revenues to get back to where they were. Of course, spending went up by 30%. So if we have a recession, my 19-year figure is going to be way off. If we have a big recession from 2 to 10 years, like the Great Depression, we'd be looking at even with a 50% cut to the federal government, we would still be looking at like 25 to 30 years of paying back our student, our federal government loans. So let's just put it this way. You know, because we just walked through the numbers, and I know because I just walked through the numbers, and everyone who actually has half a brain cell knows that the federal government is never actually going to pay back the $31 trillion that it owes. So, along comes all these morons that keep loaning the federal government money. The federal government is like the crack addict of the world, okay? Like, completely useless for the most part, and then on top of that, like completely addicted to debt. This is like a gambling problem, basically. The federal government's never paying back, but yet people keep loaning it money as if it's like a responsible entity. So our two options really here are we default on these morons that keep loaning the federal government money. They're the ones who took the risk. They looked at it and said, the United States government will never default. And they loan the federal government money. Or we can just print more money, which is basically what happens if we raise the debt ceiling. They just keep printing more money. Until eventually the inflation makes the debt not a problem. Makes the inflation, we might owe $60 trillion, but I mean, that's about the cost of a Bentley. If you get inflation up high enough, that's basically what will happen. It takes the money from everybody. Everybody pays down the federal government, and particularly it's going to hurt people who are lower income. It's going to hurt people who work for a living. The rich are going to be able to sneak out of paying their fair share on that because they're going to hide their money from inflation. So basically, do all the rich people who took on this risk, do they get soaked? Or are we going to soak all the poor people? And I think we all know where this is going. So when they raise the debt ceiling and decide to start loaning more money and basically printing more money, that's not going to be a win for us. It's not. Honestly, we should default on it, but here's another kicker. When they raise the debt ceiling, which they will, what's going to happen is basically the federal government's been pretending like they're not borrowing a whole bunch of money. As soon as the debt ceiling goes up, they're going to go out and they're going to borrow a ton of money. And all this money is going to come out of the banks. This is going to come out of savings. You watch the banking crisis. It's going to explode again. As soon as they raise the debt ceiling and they issue all that new debt, you watch. Some of these banks are going to go down very, very quickly. The stock market is going to go down. Yeah, stock market, banks. So if we don't raise the debt ceiling, the stock market's going to crash and banks are going to go down. If we do raise it, banks are going to go down and the stock market's going to crash. You ever realize that there's a point where the consequences catch up with you? And in that moment, you realize that there's no good options left. We're there as a country. Everything we do now is going to result in bad things happening. And more, those bad things are going to look exactly the same. Whether we raise the debt ceiling or don't, same thing's going to happen. More pain coming our way. Friends, if you're not actively trying to protect your retirement funds, protect any savings that you have, and I'm talking about if you own your house and you have a whole bunch of equity in your house, that's savings. That's an investment. You need to protect it as best you can. And that's actually a fairly decent place to have it in a house. But do what you can out there. If you want to move some of your retirement funds out of stocks and bonds over into something safe like gold, silver, or platinum, if your IRA, your 401k, you want to talk to Jonathan and his team. They can answer a bunch of questions about what it would look like to move over to that and how best to protect your retirement funds. You can find them down in the description down below. Thank you all so much for watching. You want to check out another video? There's one right here. I'll see you over there, or I'll see you later. Steve Poplar of the Poplar Report, out.